Hello there, and thanks for joining me for my first discussion on leases, Part 1. Please, if you haven't already, read pages 859 through 866 in your textbook prior to viewing this video on accounting for leases. Also complete the Learn Smart for this same lesson, and then we can have a discussion that assumes that you have a basic foundational working knowledge of leases. And what you're going to find out after your reading is that although it seems pretty straightforward, leases are complicated. Who knew, huh? And that's because there are really two different types of leases. The first type of lease, I'm going to call this an operating lease right off. It's a kind of lease where you go out and you rent some equipment. You don't own the equipment. Title doesn't transfer. You don't need the equipment. Let's consider you go out and you get a grand opening sign that flashes your grand opening and that you're having a sale and that you have some grand opening hours, and you lease this sign for a week to draw attention to your business and bring in customers. You would typically pay for this by debiting rent expense and crediting cash, and this would be considered an operating lease, and it's just a short-term lease where the benefits of ownership don't transfer. Compare that now to a different kind of lease, one that's called a capital lease. It's called a capital lease because it's capitalized to the balance sheet. This would be more of a case where you go out and you get a piece of equipment and you decide to finance it by getting a lease instead of a loan. And you own it for maybe most of its useful life, or maybe you pay for most of its value in your lease payments, or maybe title transfers at the end of the lease. And that this is a lease that's really a purchase that's just financed using a leasing model. This kind of lease would be picked up on the balance sheet, and you would debit leased equipment because you've really acquired equipment and all the benefits of ownership. And you'd set up a lease liability because you would be substantially required to pay for the payments of the lease. In this kind of lease, the equipment becomes yours, or at least the majority of the equipment. If you return it at the end of the lease, you use it for more than its useful life. You probably pay the property tax and you're responsible for maintaining it. And in fact, this might surprise you, but you would actually depreciate the equipment over the life of the lease, or its useful life to you, whichever is applicable, and make a typical depreciation entry for it. So this type of lease is saying you're essentially owning the equipment, where this type of lease, the operating lease, is really saying, hey, I'm just getting this equipment on a short-term arrangement, and it's a true lease for me. Both of these lead to very different accounting. The first thing we need to be able to do is to determine what kind of lease are we looking at. Is it going to be an operating lease or a capital lease? And there's a four-pronged test. If you get a yes to any one of these, then it becomes a capital lease and you set up a liability. If you have a no to all of these questions, then you can call it a true operating lease. So then you look at the lease and you say, does the title to this lease transfer to the lessee at the end of the lease? If the answer is yes, it becomes a capital lease. If the answer is no, you go on to the second test. Is there a bargain purchase option to this lease? Can I buy this equipment as the lessee at the end of the lease for substantially less than its fair market value? If the answer is yes, it's a capital lease. If the answer is no, you go on to the third test. The third test says, are you going to have the life of the lease be more than 70% of the useful life of the equipment? If the answer is yes, it's a capital lease. If the answer is no, you go on to the fourth test. Is present value of the minimum lease payments, and we'll later, greater than 90% of the fair market value of the equipment? If the answer to that is yes, again, it's a capital lease. And if the answer is no, it's operating. So to summarize, if one of the above questions is a yes, it becomes a capital lease. But if all four are no, then it can be an operating lease. There's two more criteria for just the less or, and it's the same two criteria that are always in place whenever we're contemplating recording a sale. If you recall back in Chapter 2, before we can record a sale, we need to be sure of the collectability of the sales price and that there are no uncertain costs that remain. So the lessor must be able to answer yes to both of those in order for this to be a capital lease. You can have some really weird situations where it's not a capital lease to the lessee or the lessor, and the asset simply disappears. Kind of an interesting situation, but we'll deal with that later on. So a few more things I want to do. I want to look at some terms with you before we move on to the rest of the chapter, so we can just use those as we need to. They're kind of self-explanatory, but let's go ahead and look at them. First of all, cancelable. The lease is either cancelable or non-cancelable. If either party to the lease can walk away from it, then it's not a capital lease. If it's non-cancelable, then you know that it needs to meet the other criteria before you can really decide. But if it's cancelable, we know for sure it's not a capital lease. We talked a little bit about a bargain purchase option, and what that means is that you can buy the equipment as a lessee at the end of the life for a substantially reduced price. There's also the notion of a residual value in a lease. The notion of a residual value is how much the equipment will be worth, not at the end of its life like salvage value, but at the end of the lease. Sometimes the lessee guarantees the residual value to the lessor, saying, I promise the equipment will be worth at least this much. I'll make up the difference to you. That would be a good move if you wanted to make sure the lessee took good care of your equipment if it were a long lease, wouldn't it? And then the idea of minimum lease payments. If you take the present value of all the payments that you're going to make, plus the present value of any guaranteed residual value, or the present value of a bargain purchase option, and add all these together, they equal the minimum lease payments. It's the amount the asset is recorded for by the lessee. I'm going to add two more terms to this because we use them frequently. The lessor is the person who, at the beginning of this anyway, owns the equipment, and the lessee is the person who wants to lease the equipment and use it. So, we've defined what an operating or capital lease is, talked a little bit about what the differences are, and developed some terminology so that we can move through the remainder of the chapter more easily. Thanks for joining me, and I'll see you for part 2.